these types of vaults are pretty interesting in these types of market conditions. We've seen now that we can have major dips in a bull market, and during those kind of periods of bearishness or crabbishness, these vaults can do incredibly well. Just as an example, I deposited into this vault last week.
The mega vault on dYdX or HLP?
Yeah, the mega vault dYdX last week. And since then, I've kind of just been talking about it so much to people because it's been going so well so far. Knock on wood. I know that as soon as I say that, it's going to not do great, but I've been getting 126% APR since I entered last week. And that is just because I think the market's been super crabbish. So
welcome to today's episode of Dojo Podcast, the podcast where we talk about a bunch of yields and opportunities and what's going on in the world of DeFi. As always, I'm joined by my co-host, Mara. Markets down. I think that's fine. We're gonna go through some chop. Certainly, I don't think this is unexpected. Holding over $90,000 in Bitcoin, over $3,200 ETH, I think is just a show of strength in general. And so when things are up only, I'm typically kind of scrambling for a little bit of leverage. Don't do that. Don't do what I do. I do as I say. But when things are choppy, I get back into the trenches and I'm looking for yield. So I kind of have enjoyed a little bit of this chop because it's given me the scent for yields again. And you recently had a huge home run, or at least speculatively a home run with Usual. Can you break down why people are so excited about this potential airdrop?
Yeah. Let me just first talk a little about my sense of the market. We also do some weekly calls for the community in the DeFi Dojo, and I'm definitely not someone who is like a trader or is looking at TA. But it just felt this end of last week that we were going to have a bit of a drawback. And I talked about this a ton. We do a show on Saturday with some of the other members from the DeFi Dojo. And they were all super bulled up. They were like, we're going to, altcoins are going to be ripping. There's going to be all this kind of positivity in the market. And I was like, I've been through a few cycles now. It feels like it's gotten a little frothy. It feels like we need a bit of a reset. We typically see these things happen. That doesn't mean I'm bearish, right? That does not mean that I'm, think that the bull market's over or something like that. But I do think we did need a bit of a reset. I remain, bullish. I think that kind of this period of December tends to be very choppy as people go on vacations, as people take profit, so they can pay off taxes, all sorts of things going on, right? So I would imagine we see quite a bit of volatility between now and the end of December. And I think hopefully we get some positivity again kind of in the beginning of January. We could also go up from here. We also could, go down a bit more. I'm not trying to hedge my bets too much there, but I do think volatility is probably what's in store for us for December. And then, January, hopefully it gets to be more constructive again. In terms of
volatility means volume, and volume means fees, and fees means APRs.
Yes. And that's fantastic. And I have been, continuing to be quite active in concentrated liquidity. I do think, you can definitely get wrecked by sudden price movements to the upward or down, downward side when you're doing concentrated liquidity, and impermanent loss can be very real. On the other hand, if you were just doing something as simple as an ETH USDC or USDT pair in the last couple of days, you would have done super well. Another thing that does very well in this kind of conditions is counterparty vaults. But anyway, let's go back to Usual and we can talk about that. And then maybe we can talk about counterparty vaults or something like that afterwards.
Yeah, let's do CPVs next.
So yeah, Usual is a RWA product. They have not been around for that long. I was trying to remember exactly when they launched, but it hasn't been that long. They grew super fast. I think within the first week, they already had something like $100 million. And they now have over $600 million, in their protocol. They've also been very effective at kind of integrating in DeFi. And I know this is something me and you talk to teams all the time, and we're always banging our head against these teams saying, you guys should have as many ways of being composable as possible, and Usual's really done that. They've done a ton of stuff on Pendle, a ton of stuff more Morpho, liquidity all over the place. And I think that's really kind of led to a lot of the success. But anyway, they're going to have a token soon. We do have some price information, as you kind of have been showing. They have futures on Binance, which has been doing some pretty decent volume. So I think it gives us at least some decent idea of what they might be valued at, which is huge. $2.7 billion. Right?
I know.
This is wild. Yeah. And they've had $75 million of volume. Obviously, saying $75 million of volume supports a $2.7 billion valuation. Like that's a little wonky. I get that. That's not like a wildly high amount of volume. On the other hand, it's not nothing. It's not like we're not looking for like whales
market
numbers.
$75 million of volume is insane.
Yeah, I mean, like that's what I'm saying is like, you know, we've looked at AVO in the past. We've looked at whales markets and tried to like predict what future like, you know, post TGE token values will be. And I think it's always been very hard. This probably gives us a more realistic idea. And so I think that I think they've like somehow cemented themselves into this narrative of being kind of like, sort of like Ondo, sort of like Athena. Both of those two products have been doing super duper well recently. And I think that's probably why they've had so much success. But the other reason that this is kind of like so much in people's, you know, headlines is like for a long time buying YTs has been a bit of a losing strategy, right? Like if you bought YTs for, you know, many of the LRTs and other products for the last few months when like, you know, it was season 2 and 3 and whatever of different airdrops, a lot of people got burnt. Now, there are very skilled people who know what they're doing and can really kind of like price these YTs super efficiently. And they have made money, right? But just like there hasn't been a YT where people just broadly bought it and just made a ton of money, except for usual. And usually,
I mean, it was a 2x back when it was like 1 billion valuation. Is it now like a 3-4x on principle? So the YTs, I was doing some like speculative math. If you had purchased a YT, I think it was like 20% or at 15%, you've already 2x'd effectively, given the airdrop numbers, your principal. But it may even be like a 4 to 5x at this point.
I think, yeah, sorry, I didn't quite understand what you're saying. Yeah, so from, I was lucky enough to get into this, and there was a point where I was like, you know, when this first launched, I was very excited, and I deposited, and I got into the YTs, and I was LPing, which kind of, you know, makes the like historical math a little bit confusing and complicated. I did find one wallet where I had just bought YTs and it was like about a 4.4x on the principal, which is pretty great.
And are you hedging on anywhere your airdrop, or are you still letting it ride like Hyperliquid or, you know, some of these big launches that it was better not to hedge?
No, I've hedged about 50%. The funding rate has been pretty brutal, so like that's why I'm not hedging the whole thing, but like definitely trying to lock this in. The other thing which you're showing here, which I think is fabulous, and I have now been dipping my toes
into. Fixed rate, fixed date, 50 day is insane.
50 days, 44% essentially, like on your stable coins, which is wild. I mean, that is, you know, just so...
That's more than twice as good as Anchor.
It's more than twice as good as Anchor, and you're also earning, you know, like in 50 days, you're earning like the entire yield you would get from a traditional like treasury product, right?
Oh,
like,
yeah.
You're earning about...
If you want risky way, for those of you who don't know and who can see this, I know some people might be listening to this. If you just click on the PT, if you're wondering like, well, okay, 43%, 50 days, I don't know what my ROI is going to be. You can just go in and like, we'll denominate it in USDC, makes it super easy. And let's just say you deposited $10,000 of USDC. What you're going to get is 10,510 USD plus, which is such a 0 plus, which is such a funny thing to say. What that tells you though is the amount of USD plus usual USD, I'll just call it usual USD, that you will have at the end of maturity. So by the end of maturity, you will be able to redeem these for 10,510 usual USDs, which are worth $1. So you're making an ROI, a dollar denominated ROI of 510. Now 510 on $10,000 is 5.1%. So that's a 5.1% in 50 days, you know, a whole percent every 10 days, almost an entire percent ROI per week. That's crazy. That's nuts. And you're locking that in. It's not like it's going to be volatile and variable and you might not get it. You might get it. You're locking it in at the time of opening this position. So you're locking in your ROI as long as you hold it to expiry. Absolutely insane. So explain to me, why is the implied yield so high right now? Because hasn't the snapshot already been taken for season 1?
It has already been taken. They are going to continue to have additional airdrops. And so I think people have seen all these other folks make money and now they want to join the party. I actually think that people buying YTs probably will, even at this level, potentially make money. It's a little hard to say. Usual is kind of somehow claiming that the current rate is about 67%. So you're arbitraging a difference of 20 odd percent, you know, times the leverage that Y.
But you're saying 67% at the pre-market pricing, which
yes,
is semi-speculative. and
Oh,
maybe
absolutely.
inflated.
Super speculative. I played season 1 primarily in the YTs, and I'm already moving into the. It just historically, further seasons do not tend to have as good of an ROI as the first one. That's just like typically how it works. But yeah, I'm definitely in these PTs. And just to be clear, another thing I just want to mention for folks, you need to be careful when you're swapping. Pendle, unfortunately, their swap mechanism is not super efficient. On this 10K swap right here, it's not very bad. It's only like 5 bips, which you will absolutely overcome, with like the yield that you're going to be getting. I guess nothing in DeFi is absolutely.
Even at $100,000, there's still a 5% return.
Yeah. Well, anyway,
one thing you want to look at, and you always point this out to me, so credit to you, is that you can go to the book and effectively see like how much liquidity is there on the bid and ask side, and that'll give you a good sense of sort of where you'll land on implied yield after you've made your purchase. And you can also set limit orders. This is one thing that you have sort of harped on and done really well with. So you've set limit orders, up to 45, 46, 48%, and you got filled because there's just been so much demand to scramble into these things.
Yeah, so I set a bunch of limit orders at 46, and I was getting filled on those. When this was only at like 40%, even 38, the order book has filled up. Like there is a lot of demand for YTs, which is fabulous for people that want to buy PTs. This is really rough for Pendle. This is one of the most robust order books with a pretty tight spread that I've seen in a long while. So like that just shows you the robust demand here. When I was doing this a few days ago, it did not look this good, and so I had to set limit orders. In this case, you probably could just swap. Like you could probably just get away with doing that. In most other cases with Pendle, I would definitely set a limit order. I sometimes just set stink bids where I just like go super high and people just fat finger it, and you can pick up some pretty sweet deals at implied yields that like you wouldn't otherwise be able to get. I think that you can leverage this up. So this is a 50-day PT on Morpho. When I looked at it, there was just
because we've been interested in leveraging up these PTs, and they have historically been pretty good plays. Leveraging up the PTS USDEs have been really good, but we've now seen this new, I don't even know what the word for it is, this new risk maybe, or this new like concern that I hadn't previously considered. And now it's like sort of rearing its ugly head, especially with Usual. Usual is a great example. So the PT has been increasing pretty rapidly. I think if we go back to the chart, you'll see sort of the sort of gone from implied APY of 29%. Now it's at an implied APY of 44%. And that's crazy. If we zoom out even farther, maybe it'll be even lower. Yeah, maybe its lowest is around 29%. But the reason why this is concerning, and it's also concerning for some of the SUSDEs, is because when you are doing the loop, you're not exposed to the IY. You're not exposed to the implied yield on your collateral. Your collateral, it has a fixed rate yield of whatever you purchase it at, because it's effectively a bond. It's like collateralizing a bond. And the borrow rate, however, is much more tied and reflective of the IY. So if the IY spikes from 29% to 43%, well then now new people buying the PTs are going to go and collateralize, and they're going to borrow, and they don't care if they're borrowing at a 30% interest rate because they're arbitraging a 10% difference there. But if you had gone in there at your 29% fixed rate, fixed date, now all of a sudden your strategy is no longer profitable. So what we've seen is some people looking and seeing a 15%, a 16%, 17% fixed rate, fixed date yield on these stablecoins, and they say, oh, this is fantastic. They buy those PTs, they collateralize them on, let's just say Morpho, and they loop them up when the interest rate is like 10%. And then the IY, the implied yield, the fixed rate, fixed date yield, goes from 15% to like 30%. And now all of a sudden, people are buying and fixing those rates, putting them in Morpho, looping them up, and driving the interest rate above, was it 20%? And the older people's strategies are no longer profitable, and they have to unwind. And if they're unwinding, like you said, Pendle can be very fickle when swapping. And if you're not waiting until maturity, you have to swap through that liquidity. And it can be painful. You can lose, multiple percentages of principal. And that is one risk vector that I had not previously considered, is how the IY can actually affect the borrow cost and borrow interest rate.
If you actually click on weekly instead of daily, you can see that the IY was even much lower previously. Can you just explain, it was 21% there. So I guess, another 10% less kind of thing. So another thing which maybe people don't quite understand, which I think would be great, Stephen, if you could explain, is so people are selling, they are when they create this position, they're selling their yield and they're getting a fixed rate return. They're going in there collateralizing that on Morpho. They're borrowing more and they're looping it up. Now, can you just explain for a second how it works on the exit, right? So like, if someone is exiting their position, they're essentially having to buy the YT now. Now, the price of that YT so they can close their position, is that how that works? Or
I mean, it's swapping through the PT liquidity pool, which when you swap PT into it, adds more PT, which has to have more YT, so more YT is minted, or to make sure that the levels are the same or something. Effectively, when you swap out of it, it's going through the PT liquidity pools, but those PT liquidity pools, because of the balance of PT versus versus SY, affect the amount of YT minted, and more YT minted means lower implied yield. So I think that's right. So no, higher implied yield. If you're selling the PTs, you're increasing the implied yield. If you're buying them, no, I was right. Lower yield. Yeah, more YTs minted. So you're also affecting the price. You're affecting the YTs. You're affecting the implied yield. There we go. And if you are selling large sums of these, you are also having, a price impact or an implied yield impact. And so that can be another side effect of, or another thing that hurts you.
Wouldn't that push the implied yield up though? Because like people are having to buy the YT to get a full asset to exit the position. So they're selling their PT, which means that they're having to buy some YT. They're selling PT, which means that a portion that is going into YT, which is pushing up the price of YT to create a full SY. I know that's a mouthful, but I think that's how it works. Mm-hmm. So I think the implied yield would be going up.
So we're selling I know I've done this. We've done this theory so many times. Let's just sell $1 million because that'll have an impact. So if you sell, then the implied yield goes, wow, it doesn't change at all. That is insane. It should change. Implied APY change. Let's sell 10 million. Market is insufficient. Okay, that doesn't help at all. 43.8, but you would get 45.56. So maybe you are right. It does go up.
Yeah, I think
yeah, right. So you're doing worse because if you sell and the IY is higher, that means you get less back. A higher IY means a larger bond. A larger bond means a larger discount. A larger discount means your PT is worth less. If it's worth less, that means when you sell it, you take a hit. There we go. Thank you. Yeah. Good explanation.
Yeah, because I was thinking about it as like, oh, there's more demand for the asset. It might be easier to get out of the position. It's more liquid. The book looks good. For those people that are having to unwind their Morpho positions, maybe it's not the end of the world for them. Maybe they've done pretty well on it. And then I was thinking about, oh man, they sold their YT low and now they're having to buy it back higher. So I do think that people...
Oh, well, yeah, there is that too. So if you entered at a low IY and are exiting at a higher IY, one, you didn't actually realize the APR you thought you did, because as the IY increases, the yield you purchased at, the bond rate you purchased at, is not linear. It's not like it matures at a consistent pace to expiry. Rather, it will always mature at the full value of the bond at expiry, but it is not a consistent rate, and the IY determines that rate. So like right now it is maturing at a rate of 43.8% APR. When you purchased it, it was maturing at a rate of 15 point whatever percent APR. But the higher the IY, the larger the current discount. So your PT value can actually go down and up, and it goes down if the IY increases rapidly. It goes up if the IY decreases rapidly. And so exiting at a higher IY can be certainly painful, and also mean that you may have been unknowingly running a net negative strategy because your effective APR was lower in the time span you were in that position.
Yeah, it's fascinating how the Pendle mechanics work. I'm really looking forward to Ouroboros. I think at some point in the future, Stephen, we need to dedicate some time and have a show where either me and you just talk about Ouroboros and like the new stuff that Pendle's building, or maybe bring on Tian or someone else from the Pendle team to talk about it, because Pendle's become such a powerful primitive in the DeFi space, and they're not stopping. So I'm excited.
X coming out soon. Ouroboros is coming out in the next couple of weeks. Yeah. So really, we should have one of them on soon. Right side is great. Tian would be awesome. I'm bummed he's not coming to Denver, but that's all right. By the way, we might be doing an event in Denver. Just a little bit of alpha. We will see. I don't want to release any details too early.
Yeah, exciting stuff. Anyway, should we move on and talk about...
Let's talk about counterparty vaults.
Cool. Just to set the stage... Oh, go ahead. Sorry, go ahead.
I was going to say, do check out Pendle's fixed rate, fixed date returns, because they are interesting. Do remember what we said. If the IY increases, you can have, I guess it's kind of like impermanent loss, right? Because it really is impermanent in this case. If you hold to expiry, it will never be impermanent. You will have all of your realized gains, or actually it'll necessarily be impermanent because you won't have those losses. Just understand what you're investing in. I think that's the biggest thing there. And also understand that morpho markets demand can be kind of fickle. Look at this bar APY, 12,000%. I should be lending to that. That'd be a lot of fun, but it's already expired, so you can't. Go ahead.
Well, I wish you could lend directly to it, but you have to use an earn product, which is, I always find it kind of frustrating with Morpho. Like, I understand why they do this, because it would be such a hassle to constantly be looking at these rates and pulling in and out of different markets and like finding the best market that can, like you can lend out to. Instead, what they have is a risk curators who are accepting different assets like USDC and DAI and USDT and ETH and whatever else. And then these assets are then distributed to the Morpho pools. But sometimes I see opportunities like that and I'm like, hey, I want to be able to just deposit myself, which I wish I could.
Right. But which is more like Silo. Silo is where you just deposit right into an opportunity. Those silos now moving towards a more like Morpho-esque model. And then I think not Gearbox, Euler is kind of in the middle of the two. They have both. You can have both of those options.
Right. Exactly.
CPVs.
Cool.
One of the most
pieces here.
Yeah. So we've talked a little bit about CPVs. CPVs, by the way, is a acronym for Counterparty Vault. It is tantamount to being the house, like a casino. Basically, you are the counterparty to all of the gamblers. Now, some of the biggest, most popular examples of this, I say currently, are JLP and HLP. Historically, the big one that everyone knew and recognized was GLP. This was from GMX. And even before that, you had Gains DAI. And I think even before Gains DAI, there was just the Gains DAI Vault. Before GDAI existed, they actually had a USDC Vault back then too. So I think that may have been the first one. Then GMX with GLP. Now they have GLV. We'll talk about that. We'll also talk about their sort of single delta GM assets, which I think are really fascinating, actually. And Hyperliquid has this semi-similar CPV mechanism, but I think it's taking sort of a like algorithmically determined or rebalancing long short positions. It's kind of like a long short book, and I think they do some good beta management. It's not what I would consider a traditional CPV, but it's done really well, and 55% APR, and none of that is like denominated in emissions or hyperinflationary tokens. And we'll talk about one that kind of has emissions that I really actually like, which is dYdX's vault. But Hyperliquid's vault has been doing really well. I will say, I can't sort by APR. The APR on HLP has been inconsistent. Like right now it's 55%. That's fantastic. It hovers around 30%, I'd say, more commonly. It has gone as low as like 12% or 5% for some weeks. So do be mindful. This is not like set and forget. It's going to be 55% all the time, but it has been really positive, and its return has, look at it. It's been pretty good. So I think that's, there had been, again, slow movement here and then more rapid movement here. Go ahead.
Just to differentiate these things a little bit. So I think we do have like this, like GLP, which is GMX's version of this, which has been copied tons and tons of times. And that is slightly different, right? Like that's a basket of assets. So it's like your ETH, your BTC. In the case of like the Jupiter one, which is called JLP, you've also got Sol in there. You've got stablecoins. You've got all these different assets, right? And basically what ends up being happening is as people are trading on the perp dex, they are borrowing your assets, your stablecoins, your ETH, your BTC, whatever, and then they're using that to get leverage, right? And so you are exposed to the trader's profit and losses, because they're literally borrowing your assets. And if they win, they get to keep them. And if they lose, then you get to keep their assets, And in addition to that, they're paying, funding rates and all sorts of fees. There's also with swap fees with JLP from back in the day. And then you have this Hyperliquid one and the dYdX one, which I think are pretty similar to one another. I think dYdX has essentially kind of copied this HLP model. And this is just denominated in stables, right? This is just you're depositing, USDC into these vaults, and then they are doing high frequency trading with it. I think that they are trying to kind of balance out the books, and so they're taking advantage of funding rates when things get really super high and wonky on dYdX and Hyperliquid. They're also kind of taking the other side of the trade. So people are trading, with really high leverage in one direction or the other. I don't think that they're doing like a full position. Like it does look a little different here. If I look at this one compared to the dYdX one, this one says like 28x short Atom, which would be pretty incredible if they were really 20x short. If you look at the dYdX one, it seems like the position sizes are with a lot less leverage. And I think that they're kind of like,
Yeah, I don't even know how to explain this. This is a 0.5 of an X of leverage.
Yeah, it's like five pip leverage. I also don't know if that annotation is just wrong. It seems all very confusing. But anyway, I do think that, these types of vaults are pretty interesting in these types of market conditions. We've seen now that we can have major dips in a bull market, and during those kind of periods of bearishness or crabbishness, these vaults can do incredibly well. Just as an example, I deposited into this vault last week.
The mega vault on dYdX or HLP?
Yeah, the Megavault dYdX last week. And since then, I've kind of just been talking about it so much to people because it's been going so well so far. Knock on wood. I know that as soon as I say that, it's going to not do great, but I've been getting 126% APR since I entered last week. And that is just because I think the market's been super crabbish. So you can see the slope of this thing. I kind of got lucky and right at that point where the slope starts going kind of a bit more exponential in the profit. If you go back to the vault P&L, I just luckily got in right around there. And since the slope has increased, I've been not getting that 54%, which other people have been getting.
It is probably an average of these two lines.
Yeah, I think it's the monthly thing, and since the vault's inception, maybe, or something like that. Anyway, I've been getting 126%. I'm up over 2% in less than a week, and it's been great, right? That being said,
let's talk about this. It's the way that this works is not necessarily the same as other CPVs. Other CPVs tend to be paid out fully in fees plus trader P&L. I think that's the case with Hyperliquid. That's the case with the GLPs or all of the GMX CPVs. It's also the case with Jupiter. This one, dYdX is kind of making a push to have a competitive counterparty vault system. And so they are incentivizing this in some sense, not with dYdX, but I think with a bunch of their huge cache of USDC that they sort of generated from all their fees.
Yeah, so there's a proposal where they go through this. This was passed a couple, maybe even a month or so ago. But essentially what they're doing is this. dYdX makes, I think in the last year, it made $80 million. That's this V4, this current version of dYdX made $80 million. That was going, different places. It was going, I think, maybe to the foundation, but definitely going to dYdX stakers, and they were getting paid in USDC. Now they've changed it. And so I think 50% is still in that old model of going to stakers and other places, but 50% of the revenue of the entire dYdX protocol is going to this vault now. So, you not only are profiting from the profit and loss of the traders and the strategy that's being implemented by this vault, but you are also getting this kind of steady flow of USDC into the vault, which, could amount to being something like $40 million over the year. And so if this vault, when I entered this, it was at 40 million. It's grown by a bit since then, but
yeah, 47 million now. So 40 million, if you do 47 million divided by, 40 million divided by 47 million, you're probably around 90, maybe 85% APR.
Right. And that's not including the underlying strategy and the funding rate arbitrage it's doing and the trader's profit and loss being absorbed. It would be in addition to that. So who knows? All right. This vault, I don't want to give the idea that this vault does not have risks. It has massive risks, right? The traders could start winning.
Massive might not be the right word here. I would say it has risks. They're not systemic or existential, but there is risk of negative P&L, or it's not like a stablecoin that always has interest. There are risks of drawdown.
There's risks of drawdown. If we go into a period again where the markets are just going up and traders are winning, then this vault will lose money.
Yeah, but
also
my sense is, and I could be wrong. I mean, again, just looking at these numbers, who really knows the truth here? But it looks like the leverage is much more calm or lower than some of the other CPVs you looked at.
Yeah, no, I think that's true. But I do also want to point out, since we're talking about risks, dYdX was exploited like that. I mean, they fully repaid. They had an Oracle issue, I think, on some liquid market, so there are real risks here. As you can see, there have been drawdowns. When they first got started, there was it went negative,
massive, a 50%
or something like that. Yeah. So
it's P&L.
Right.
So yeah, go ahead.
Anyway, I'm in this vault. I probably won't be in it forever, but I think if we're going to have high volatility, which is what I'm betting on between now and kind of the start of the new year, this kind of thing could be great, and it's very easy to get in and out of, and I'm just kind of sitting in USDC. I took profits this weekend on some alts. I was just very lucky in timing that, and I had rotated some stables over here, and I just added more to it this weekend. So I think that having strategies like that where you can kind of, I'm not very good at timing the markets, but just kind of kind of slowly moving in and out of alt positions, moving into CPVs. I think that there's quite a bit of edge that can be had there.
It is interesting that JLP, dYdX Megavault, and HLP all have a 55% APR right now. It's almost uncanny that they're all like at the exact same spot. I will say not so. So there's other ways to differentiate these things. HLP, kind of like a stable coin, but I will say that there is like some sort of volatility to it. And so the APR is effectively where you're getting on a dollar denominated position. So like 55% means you're roughly going to see a 55% return on like a dollar denominated position over time. JLP is a basket of assets, and it's like the return you'll get on that basket over time. And it is a weighted basket of a bunch of different things. We've talked about its performance in the past. You kind of know what the deal is here. So it's not really like a stablecoin. Megavault, very discreetly a stablecoin vault. I think you deposit stablecoins directly into it. Maybe it's even USDC, and then you get your payment in USDC or an increase that way. Is that correct? It's not like a vault token that increases in value.
You just get more USDC.
Right.
Yeah, you spot in USDC and you get more USDC out. Yeah. Rather than the other ones where there's actual like an index of assets that are in them.
Yes. And I will say Hyperliquid, not a composable like 4626 vault. It's more like a strategy that you deposit into on Hyperliquid and then you get a return. So like all of these are different in different ways. JLP is an index. It is composable. Megavault, stablecoin deposit, stablecoin emissions. Hyperliquid, you deposit and then you just withdraw more capital if it performs well. But you are exposed to sort of a basket of different things, even though it acts more or less like a stablecoin opportunity. GMX is where I wanted to get to because they have these V2 assets that have performed pretty interestingly. I will say I have talked to GMX a few times now, and I'm still not entirely sure how the what I would call like the LPs work, the ones that are like BTC USD or ETH USD. I've tried to understand, are these like constantly rebalanced? Are they not? And, the GMX team was explaining that the metrics, the benchmarks are as if the benchmark is comparing it to as if it was rebalanced daily. They didn't tell me whether or not they were rebalanced daily. So I'm not going to talk too much about those because I will say there is a level of ignorance there that I haven't overcome. But I do want to talk about, and this must be here it is. Okay. I do want to talk about the performance of some of these assets. So like the GM ETH and GM BTC are singly are only exposed to ETH or BTC. So single delta exposure to ETH or BTC. And effectively the way they work is they have, you can see, let's do BTC. So this one is only exposed to BTC. You can see here underneath it in the subtext, it just says BTC as opposed to the one above it, which is BTC USD, which is roughly a 50-50 split between BTC and USD. So it's kind of like being half delta exposed, but semi-unclear whether or not that's exactly right. And it gets fees. It's a counterparty vault, right? So fees plus trader P&L. And if you go to the performance versus benchmark being BTC, and you look at how it's performed, so unclick all and then go to ETH, and there you go, single ETH and single BTC. You can see that since, let's just say September, BTC I think is up like 5 or 6%. It's loading very slowly. Yeah, it's going to load slow. I can't really show you guys, but if you go to this website, you will see my computer is really riding the struggle bus today trying to show you. It's up 4% in 2 months, maybe a little bit 5%. I think its high was 8%. So it does go a little bit up and down, but the chart looks nice, and the implied APR here, let's just say 3 months, 3%, 12% is pretty good on Bitcoin, and it has been higher. So it does go up and down depending on sort of the volatility of the markets. So there's that. And then the other sort of semi-fascinating thing are the blue chips. So like with GMX, you also have like these uni USD positions, or I think they have a number of these. Uni was one of them. Pep, Hey, Whiff. I guess they have a lot of Aave. So they have these things that you can get a yield on, like Aave USD, roughly, again, half exposed to Aave, getting 37%. And I don't think you get impermanent loss the same way you would for a full range LP, but that's one thing that I still need to do a little bit more math on to fully understand.
Yeah, and the beauty of these things is they're composable. So you can go and you can take them to Dolomite, right? Do you want to just kind of walk us through the Dolomite strategy real quick?
I think Dolomite's the only place where these things are composable. So I actually have the leveraged Bitcoin position open. I can probably show you guys my test position on Dolomite. I have done the math and I've actually annualized my return. So I entered, I think, October 22nd. And if I wanted to exit my position altogether, I just would click like repay. and then Zap, and then Max, and withdrawals rep Bitcoin. So I entered with 0.001208, I think. And so you can see I would get 0.001339, which is roughly at this point, I don't know if this shows my ROI. My ROI is like 1.9% now. So 1.9% over, you know, a little bit less than 2 months, 1.5 months, maybe it annualizes to about 30% APR. So I've, on my leveraged GMBTC position, I'm getting around 30% APR, fully denominated in Bitcoin. It's been pretty good. So this is my test position. I like this a lot. It's been doing really well for me. Of course, I've also ridden this up with the value of Bitcoin. So that has been nice. And so I do it the complicated way because I like to, you know, manage my own leverage. But if you want to do this with one click in, one click out, they do have strategies, and strategies just allows you to one click in, one click out, super easy. Here's that looped GM Uni USD position. Again, it is exposed. The delta exposure is kind of unclear. So that's one thing you probably want to figure out before you enter these positions. They also have like loop CMEs and all these other things. So plenty of things to look at and consider with your auto strategies they have over there.
Daddy.
In a few minutes. 5 minutes. Who go 5 minutes? 5 minutes.
I don't want to go.
Okay. Well, can you be quiet? Okay, thank you. All right, what's next?
Yeah, well, that was very interesting. I do like the idea of these vaults being composable. Like, I think taking HLP is fascinating. Like, there's been a massive amount of leverage that has been built up around JLP, which is the Jupiter version of this. So people are holding this basket of ETH, Sol, stablecoins, whatever else. As we said, it's earning this like 55% yield. And people are going and taking that and they're collateralizing it on places like Camino, and they're borrowing against it. They're using it as collateral on things like Drift and then getting additional leverage on top, using it as like this yield bearing margin or collateral. So I think that it is a very interesting space. You know, we're seeing kind of like a lot of resurgence of this. It does make me worry that there's like a ton of leverage being built up in the system. If someone's taking a JLP position and moving into Drift and then going and like leveraging on top of that, there could be some additional risk there. The same way that I think, you know, like right now we're seeing, for example, with Athena, you know, it's basically like a vault position that's doing a basis trade, but it does have exposure to perps into the markets. That, you know, in certain cases, like for example, on Bybit, you can go and you can take that, you can earn your, say, 25% on it, and then you can go and use that as margin or collateral to then trade. So, you know, I think it's very cool. I think for the yield farmers out there, having the ability to do these type of things is super capital efficient and super interesting to get high yield strategies. It just does make me a little bit like squeamish that there might be a bunch of like hidden leverage built up into the market. And then, you know, who knows how that thing eventually has to unwind, you know, when we see a shift in kind of market structure or something like that. So I don't know if that's a risk that you're worried about. It's something I'm getting a little bit more increasing worried about. It is also just interesting to look, you know, forward and think, you know, there will have to be, you know, for the markets to kind of like really cool down, or for there to be a major market crash, there needs to be probably some sort of kind of large market event. And I wonder, knock on wood, I hope it doesn't happen, but I wonder if this kind of all built up leverage, $1.5 billion in JLP, $5 billion in Athena, you know, the like GMX stuff, if like all of this like hidden multiplied leverage could be one of the factors that ends up, you know, eventually, hopefully in 2026 or whenever the market does inevitably end up crashing, be one of the causes of it, or be one of the catalysts of it maybe.
Well, it's interesting because last cycle, I thought that was going to be the case with all of the leveraged staked ETH. I thought, okay, well, we have wrap staked ETH, and then we had like, you could leverage wrap staked ETH. And then I think Index Co-op or Index Coop, they created a tokenized version of the leverage wrap staked ETH. And I just thought, well, it could be turtles all the way down. You could have leverage versions of that and leverage versions of that and composable. And it is an issue theoretically. It's like the housing market collapse, where it's just derivatives of derivatives of derivatives that are all, you know, hyper leveraged speculative plays on the primitive. But in TradFi, there's enough liquidity for you to do that. Here, there isn't. And so one of the things I really appreciate is the role of people like Gauntlet and Chaos, where effectively they're working with all these money markets and saying, you can't have this much leverage until these assets have this much liquidity. And then they're specifically talking for a particular market. So like, you know, this LRT, this LST can only have X amount of leverage or can only have X amount of LTV currently until it has more liquidity. And then you can increase that, because right now there's sort of like systematic, or like it would pose a risk for liquidators and for the protocol or for lenders if you risk this much, if you have this high of an LTV, because liquidation would just be very difficult. And I think that like there are these people playing the risk mitigation game all around and effectively saying like, this is an okay amount of leverage because liquidity can handle it, or this is not an okay amount of leverage because liquidity really can't handle it. And so you'd have just massive impact. I don't think that Athena is going to be the thing that causes the crash. And I think even if Athena, Athena has a bunch of short positions, so I don't think they're leveraged long. So if the markets crash, I think they'll be fine. What's going to be the catalyst? Who's going to suffer the most? I am not sure. Athena will not do well in a bear market. Funding rates are just not very good. The stablecoin yield rate will not be interesting. I think they'll lose a ton of TVL. Athena is really a bull market product, in my opinion. And I think other people, the tokenized treasury bills will do really well in a bear market. Tokenized credit debt obligations will do really well in a bear market. Syrup, Maple, Anzin, Ondo, the Mantra, they'll all probably have a solidified place during the bear market. And I worry that, Usual doing incredibly well right now, and maybe some of these other RWA assets is a sign that people are front running the end of the bull. I hope that I'm wrong there. It's just a little bit of a conspiracy theory. I don't know what's going to cause the bear market, because it's going to be a bunch of black swans, right? It's going to be one black swan after the other. It's typically how these bear markets happen, just like 1-2 punches over and over and over again. So have an exit strategy and find a safe haven in, the bluest of chip protocols, probably. Maybe some stable coins that seem like safe havens, and hopefully you can get some yields on those. I think that's the way to go. Maybe some funding arbitrage. Those are fun.
Yeah, no, I agree. I think, there's an interesting kind of pivoting that can happen, right? Like you, as the markets were going up, were taking on leverage. I was buying altcoins, exit some of those positions, jumped into the counterparty vault plays to earn some yield when I think we're going to have a period of volatility. I didn't fully sell out. I'm still have exposure, but I took profits basically, and I'm trying to get some yield on those profits. I may jump back in, but it is interesting to kind of think about these profit taking strategies. Are these counterparty vaults good options? I think in some cases they definitely are. But there's also just a pretty handsome yield you can go, as we were talking about, going and buy PTs for 40%, lending out your tables on places like Fluid.
With no real and other risk.
Right. And other places and getting paid, 15 to 30%. So yields abound right now. It's just do you want to be more focused on volatile assets, or do you want to be more focused on yield? I had been pretty focused on volatile assets for a while, and I'm shifting more and more back into yield.
So one thing we've neglected to talk about is the big OP grant that finally went live on Contango.
That's super exciting. Will you want to just walk us through this? Wow, these are juicy yields, aren't they?
Yeah, and I mean, max amount is max principal amount. So it's not even leveraged amount. The max principal amount for some of these is 450 ETH, 10 ETH, Morpho, compound, maybe, not too much there, but 45 ETH for easy ETH if you want to leverage and get some points there. Or I don't even know what Renzo is doing anymore. I know that last season probably ended, so we'll have to get some more information on that. But you would get, Eigen theoretically on top of all this. So that's kind of cool. So basically what's happening is Contango. Contango got I want to say 100,000 OP grant. Is this? Yeah, here it is. So 100,000 OP. And the first 40,000 are being distributed to YBA, yield-bearing assets, across optimism markets on Contango. So right now, I would say most of those are going towards ETH derivatives. We've sort of seen this if we go back over to Contango. 43% APR on top of a 21% APR on Aave. Same thing sort of over here. This is a wrap stake ETH or RETH. Granted, you're not going to get any points or LRT participation. You could for WeETH on compound, but not a lot of space there yet. Hopefully we'll see some caps raise over there. But silo markets also being highly incentivized. Is on their compound market, you would get LRT participation there. So that's kind of cool. Decent ETH yields, right? There's no real, as far as I know, all of the markets that we looked at, fundamental oracles, do know your oracle before leveraging. So that's kind of a good thing. You shouldn't be liquidated through price action. One thing I will say, because I participated in the last round of optimism incentives, I think it was on Easy ETH back then, is Optimism is a unique chain in that its liquidity is not particularly deep. And so entering and exiting what you would think would be hyper liquid pairs like wrap staked ETH can still be painful with size. So the risk here, in my opinion, not liquidation. I think most of these are fundamental oracles. It is not that the yield isn't what you're going to get. You should get these yields. And at the very least, you're going to get the base rate yield, which is a 21% on Aave. That's a pretty sturdy and like stable yield. The OP incentives are going to get diluted by new depositors, so that's going to happen. But right now they are 43%, and they have 60,000 sort of in the tank if they meet certain metrics that they can continue throughout this. So it's not like this is the end of this campaign. There's going to be more incentives. Not even half of them are currently being admitted. The risk is size and slippage. So if you're coming in here with $100,000, $200,000, really those are the sizes that I'd be concerned about, 6 figures plus, you may have a 0.5% price impact on wrap staked ETH when you're leveraging. And 0.5% at 10x leverage is 5%. 5% on your principal is terrible. You're not going to make that up through, a 50% or, a sort of 64% APR in a month, right? It's going to take you almost you would. But if you're hitting that entering and hitting that exiting, it's going to be really painful. Typically, I think it's exiting because I do think some of these leverage go through the contract. So there's not a lot of not the leverager, but the underlying Odos protocol. So I think Odos, they have a bunch of other DEX they can use the staking contract. So leveraging up is not the issue. It's leveraging down really is the issue. So just be mindful of that. Optimism does have some liquidity constraints. If you're going in with size, you should simulate entering and exiting on a DEX aggregator. You can try simulating entering and exiting on Contango. And then, more importantly, if you do enter a big position like I have in the past, and you simulate your exit and you would be exiting at a big loss, just wait. So I simulated an exit on roughly, I think it was like $150,000 position. So leverage up 10x, probably $1 million position. And I simulated an exit and it was like a 27% principal loss. And it was a wrap staked ETH market, which I thought would just be a super liquid market. And then half an hour later, I simulated again and it was a 30 bip loss. So really liquidity conditions can change rapidly. Optimism for some of these big pairs, and don't be hasty. If you're taking a big loss, just wait. You'll probably be fine. And there are also ways to manually deleverage if you have to, which can save you from loss. So that's my spiel on the potential risks of this incentive campaign. I'm not just going to sit here and shill it to you, even though I would love to. I do want you guys to know that these high yields, 64% APR on wrap staked ETH, the bluest of blue chips for LSTs, can have some risk.
Yeah, I think that's a super valid point. One nice thing about Contango is they do have free flash loans. So you can get a bit of a bonus from doing that. One thing I've done trying to play in these sometimes very liquid markets is you can enter a Contango position, not fully leverage it, and then just pull out the kind of remaining, ETH borrow power that you have to kind of quasi cheat loop, into it, and then go do something else with that ETH. And then when you want to repay it, come back, bring that ETH in, use that as foothold to kind of start exiting your position. So you have to experience less of the potential price impact and swap fees and stuff. But yeah, I think there's some very interesting opportunities on Optimism right now. Contango's a great place for it. Compound's a great place for it. I'm definitely keeping an eye.
Aren't live yet, as far as I know.
Oh yeah, you're right. So this is just the Contango, right? So this is going to get even juicier, is what you're telling me.
That's right. Yeah. So as far as I know, Compound is they're waiting to build up a little bit more on the lend side liquidity. They're doing that through various different means. I think Beefy is even one of them. Check out Beefy, right? But once that happens, then they're going to be co-incentivizing with Contango, and the yields on some of the Compound markets will be even more dramatic. So that'll be really exciting when that happens. Do be on the lookout. I think they also have 100,000 or something like that OP to give out. Maybe they also have to hit certain metrics to start doing that. So we'll see, but that should just boost the APRs wildly. I don't know if it means take out a short position on OP because there's going to be so many incentives flowing. Typically that has not played as well as you think it might, but you can always hedge your incentives too, which is one other thing. Very quickly, I do want to just mention, if you're chasing Bitcoin yields, and I certainly have been a Bitcoin yield chaser recently, just have had more exposure to Bitcoin, you should know some things about these PTs. One, I love leveraging PTs, so don't get me wrong. But two, they're probably pretty confusing looking to the average person. Like now we have PTC, LBTC, Z24E. You probably don't know what most of that means. So just to break it down, PT just means like the fixed rate, fixed date token. C just means it's also deposited in Corn, which is kind of like a Alt L2 that's really Bitcoin centric. It hasn't launched yet. You can think of it kind of like Zircuit for now, though Zircuit has launched, but Zircuit pre-launch, it's just like it's a chain. It's going to give you some points. It's going to have an airdrop at some point in time. And hey, the Zircuit airdrop was actually pretty good. So if Corn can deliver, that could be fun too. So it's the Corn wrapped L, BTC, L being Lombard, Bitcoin, Z. This is the first thing that kind of gets really weird. What does Z mean here? Well, they're using the CME denotation now. So instead of like telling you the month as a name, it's the letter for the CME, which is Z, and Z means December. So it's not super intuitive. You should go look at CME contract month codes to get a handle of them. Maybe print this out, stick it near your computer screen if you're doing a lot of PT leveraging. So this is December 24th. So that means there's only roughly 14 days left on this. So even though it is an 88% leveraged yield, which is what, 1/25th of a year. So 1/25th of 88%, still not bad. You're still probably going to get a 2% ROI, maybe even 3%. But the problem is you're paying probably 0.5% to enter, 0.5% to exit. There are some concerns here. So do know when your expiry is, because that should give you a little bit more information on whether or not it's worth getting into now. You know, some of these later expiry ones might be more interesting. I think this is March H. And so 40% on a March expiry, much more time to generate a nice ROI in the interim. But definitely remember all of the PT risks we talked about before. So that's just that. And if you hold to expiry on Contango, you also exit through the claim contracts. So you're not going to be getting hit by any slippage or swapping issues through the pools, at least. Like if you're doing huge size, converting LBTC to wrap Bitcoin, there might be slippage between those two assets, but Pendle is not going to be the issue there.
Fascinating. Well, you learn something new every day or every week in the Dojo pod. I had no idea what all those letters and numbers meant. So really fascinating. Thank you, Steven. This has been a very interesting show. Any last things you got?
I mean, there were so many things. I want to talk about D2 because I gave them, I talked about them before and I did not do them justice. You can, just really quickly, you can deposit into these things. I couldn't figure out how to do before. There's like a window you deposit into. When you deposit into the window, then it like locks it up for a certain amount of days. So it shows you withdrawals open in 9 days. So here there's 9 days left on this strategy lockup, and the current annualized APR for the strategy is 105%. These have been really good, like absurdly good. I like to compare these to like the options vaults of last cycle, except these have just been performing much better. Some of those did too for a while until they didn't, but I just wanted to, give a shout out to D2. I did them dirty with a little shout out prior. So we have had a lot of people in the dojo who have been participating in these things and have just been killing it with their returns. So go check out D2. Not a sponsor, but I feel bad for shaming them unnecessarily. Thank you guys for watching, and I hope you have a wonderful rest of your day.